Hello everyone, welcome to the channel. We're back again with another educational video. Now in today's video, we're going to talk about how you can use a whole life insurance policy for infinite banking. Several months ago, I actually put out a video where you can use an IUL, an Index Universal Life for infinite banking. Now I wanted to show you the whole life version, how that would work. So let's have some fun today, okay? So the first thing we're gonna do, the first thing you want to do is make sure that you're working with a mutual company, a mutual life insurance company for your whole life policy. All right. So there are two types of life insurance company. There is the stock company and there's the mutual company. The stock company is owned by shareholders. So it's traded on the stock market. You can buy shares of it and all that. The mutual company is actually owned by the policy owners. So why that is important is that after they're running the company, they put money into the company, pay all the expenses, reinvest in and all that. Make sure all the executives get their bonuses and all that. After that, whatever is left as profits is paid out to the policy owners in the form of dividends. Okay? So, just like a stock company, a company that's traded on the stock market, and some of them actually pay dividends to their shareholders. Now, in a mutual company, life insurance, they definitely pay dividends to their policy owners. Okay. So, the reason why that is important is that when you're doing a life insurance policy here, if you're working with a company that is not a mutual company, all right, you're going to get your guaranteed 3 or 4%, and that's it, right? And then you have to pay policy expenses and all that. But you get your guaranteed 3 or 4%, but nothing else. With a mutual company, you actually get dividends. So that's going to make your policy works better. So that dividends that you're getting paid, you can put that right back into your policy in the form of PUAs, paid up addition. Paid up additions. And what that really means is that you're actually paying for additional life insurance. So you're getting more life insurance, which give you more mech space. If you're not sure what mech is, you can watch another video that actually explain what mech is, which is a modified endowment contract. But it gives you more room to get more life insurance, so you're in line, and also more cash value. So you're dumping that money back into your policy to make that policy work better. So kind of supercharge the policy, hence giving you more cash value. Okay, so that's why you need to do that. Now, in a regular policy that's not designed for infinite banking, right? All the premium, let's say it's 20,000. Let's just use 20,000 per year as an example. 20,000 per year, okay, 20K per year. All that premium for the year is going to go into your base premium. It's going to go all to premium, 100% of it, okay? So this is why in a regular policy, the first couple of years, there's really no cash value. And if an agent sell you a policy like that, they'll tell you there's no cash value. It takes a while to build up. So the first 2 years, in most cases, there's no cash value because it's front loaded. You know, all the charges and all that is dumped at the front the first couple of years. So it's front loaded. So you're not getting any cash value here. So the difference is with a policy that's structured for infinite banking, the cash value is the main thing. You want to utilize the cash value. So therefore, you need to have that. You're not waiting till the third year to get the cash value. So that same policy that you're paying the same amount of money could be structured differently so you can take advantage of the cash value. And it could be structured where you're putting a minimum amount that you can get away with for your base premium. Let's say it's 2,000 or 3,000, whatever it is, okay, based on your particular situation. And then the rest of it is going to go into PUAs, paid up addition, which gives you access to cash value immediately. In the regular policy, that all that 20K is going to the premium. Is going to the insurance and the death benefit and the agent commission and all that. All of it. So it's 100%. All that premium is 100% base. Okay. So no cash value in year. So year one, zero cash value. Year two, zero cash. In most cases, not all cases. So a regular, a structured one that's structured for infinite banking now, you're going to minimize that, and you're gonna, let's use 2,000 as an example. 2,000 is your base premium, and then you have 18,000 going into PUAs. So in a policy like that, you might have 17,000 available right away for cash value. Where would you rather be? No cash value in year one or two, or right off the bat you get 17,000 available for cash value that you can utilize. Remember, you're using this for infinite banking purposes. You're going to borrow against that policy. So you got 17,000 there. Let's say you wanted to borrow 15,000. You're going to borrow against it, go do what you need to do, make money on top of it, pay the loan back because you're doing it in a form of loan, so you won't get taxed. Loans are not taxable. You're going to pay the loan back, and then you rinse and repeat, just like a bank would do. So that's what the concept is about. The concept is about making sure that you're leveraging your money and using it over and over again like the bank do. Rinse and repeat. The bank leverage other people's money to do this. You can do the same by leveraging your money inside a cash value life insurance policy. And the great thing about this is you have great control. You don't have to do any credit. You don't have to do any application or anything like that. You can do that whenever you want, right? So all you have to do is just ask whatever you want. As long as you have the cash value to support it there, you can do that. And like I said, in a policy structured correctly, you would have immediate cash value available in the first year, whereas over here you have no cash value. So this is how you would utilize a whole life policy to structure it for infinite banking. And at the end of the day, it's really a blended type of policy. How it works is they actually blend the whole life with term, because the term is less expensive, especially in the earlier years, I should say. It's less expensive, which will give you more life insurance. Therefore, you can be in line with the IRS code when it comes to the MEC space. So we blend it here with term insurance, so the policy is not so expensive, and we're going to get the amount of death benefit that we need, and at the same time getting the cash value out of it that we need. Hope that makes sense to you guys. Hope that information was valuable. As always, if you do like the information, if you think it's valuable, go ahead and like and share, make a comment, or ask a questions if you do have a question. And if you haven't already done so, make sure you're subscribing to the channel so that anytime I release a video, you're notified. All right? Hit the notification bell. Until next time, I'll see you soon.